Hey, everybody. Today, I figured we'd take a break from commentary on the markets and instead discuss qualified charitable distributions or QCDs, which we believe are the most tax efficient way to donate to charity. Due to the size of the standard deduction, we frequently see clients not fully benefiting from the tax advantages of their charitable gifts. While I know most of you give to charity for reasons beyond tax savings, it's nice to maximize financial efficiency while supporting a good cause. Before diving into the benefits, let's start with the basics of a qualified charitable distribution. A QCD allows individuals to donate to a public charity directly from their pre tax IRA or inherited IRA once they've reached age 70 and a half. QCDs were introduced in 2006 under the Pension Protection Act and were initially capped at $100,000 and remained unchanged until 2023. However, the Secure Act 2.0 increased the limit to $105,000 in 2024, is now $108,000 in 2025, and will be inflated annually moving forward. A few things to note: the annual limit is per person, so married couples could technically donate as much as $216,000 via QCDs from their separate IRAs in 2025. And QCDs can only be made from an IRA, not a 401k or other employer sponsored plans, and they cannot be directed to donor advised funds. There are three main reasons why we strongly advocate for QCDs. Number one is the most obvious, but QCDs help taxpayers manage their current and or future required minimum distributions. Number two, given the current size of the standard deduction and the likelihood that it will continue to grow under proposed tax extensions, QCDs help ensure that taxpayers receive the full tax benefit of their charitable contributions. And number three, QCDs lower modified adjusted gross income, or MAGI, which potentially lowers the risk of incurring monthly Medicare Part B and Part D premium surcharges in retirement. To illustrate these three benefits, let's compare two hypothetical families, John and Jane and Robert and Sally. Both John and Robert turned 73 in 2023. They filed joint returns and had a $2 million IRA balance on December 31st, 2022. The only difference between the two is that John chooses to make his $20,000 charitable gift with after-tax dollars, maybe through his donor advised fund or a personal check from a checking account, while Robert chooses to make a $20,000 charitable gift from his pre-tax IRA. Before we get too far, I'm assuming this scenario takes place in calendar year 2023 because of Medicare premium surcharges. For those unfamiliar, healthcare costs in retirement are based on income from 2 years prior. This means John and Robert's earnings in 2023 will determine their Medicare premiums in 2025. This underscores how financial decisions made today or even in previous years can have lasting effects on future retirement costs. So at age 73, John and Robert are subject to RMDs in 2023. To determine RMD liability, a taxpayer divides their December 31st account balance from the previous year by the distribution period in the IRS Uniform Lifetime Table to the right. In their case, we divide $2 million by 26 and a half years to get a $75,472 RMD that they'd need to distribute in 2023, which would be considered ordinary income taxed at their applicable income rates. As mentioned, Robert chooses to make his $20,000 charitable gift from his IRA. The $75,472 would still need to be removed from the account, but only $55,472 would be considered taxable income to Robert. One thing to note is you can execute a QCD after reaching age 70 and a half, but are not subject to RMDs until age 73, which presents an opportunity to reduce pre-tax retirement account balances via a QCD before your RMDs kick in, a strong planning technique for those that are philanthropic and are expecting significant RMD obligations. The second reason QCDs are so impactful is related to income tax deductions. When filing your personal tax returns, you must decide between itemizing or taking the standard deduction, whichever provides the greater benefit. While QCDs can benefit a taxpayer who claims either, charitable gifts made with after-tax dollars count as an itemized deduction or below-the-line deduction, only providing tax benefits for those who choose to itemize, which has become increasingly rare since the standard deduction has gotten so large. As you can see in the tables, following the 2017 Tax Cuts and Jobs Act, or TCJA, the standard deduction was effectively doubled in 2018. Now it's estimated that only about 15% of taxpayers itemize their deductions, significantly increasing the amount of donors likely not receiving the full tax benefits of their charitable gifts. If the proposed tax extensions are passed, we anticipate a slight increase in the number of taxpayers who itemize their deductions. However, the majority will likely continue to claim the standard deduction. To determine whether to itemize or take the standard deduction, you must review your personal expenses that are eligible for itemization, which are found on Schedule A of a tax return. Since the TCJA eliminated miscellaneous itemized deductions, taxpayers are now limited to deducting the following: qualified medical expenses, but only amounts exceeding 7.5% of adjusted gross income or AGI. For example, if you had $100,000 of AGI, you'd only be able to deduct medical expenses that exceeded $7,500 in a calendar year, a high bar for most taxpayers, which often results in no medical expenses being tax deductible. Next is the state and local tax, or SALT deduction, which my fellow California residents are very familiar with. This was another provision of President Trump's 2017 TCJA and limits taxpayers to $10,000 of state and local taxes that they can deduct from their federal income. This cap is a main reason why so many taxpayers now take the standard deduction rather than itemizing. It's important to note that this limit is expected to rise under the proposed tax extensions. Next is mortgage and investment interest. As most know, you can deduct interest paid on a mortgage for your primary residence or a second home. Also, taxpayers can deduct investment interest expenses, which we often see with margin loans on a taxable brokerage account or a home equity line of credit. Last is the deduction for gifts given to charity. You will most often see this when an individual donates cash directly to a charity or appreciated securities to their donor advised fund. Since John chose to make his $20,000 donation with after-tax dollars, this is where his gift would be reflected on he and his wife's tax return. For John to receive any tax benefit from his charitable gift, the sum of these deductible personal expenses would need to exceed his and Jane's 2023 standard deduction of $30,700. Now let's revisit John and Robert's scenarios and add a bit more context. Let's assume John receives a taxable pension of $100,000 a year and earns $36,529 of taxable investment interest, maybe from a CD or a money market. In this scenario, his modified adjusted gross income would be $212,001. For itemized deductions, he's capped at $10,000 of SALT, only pays $1,700 of mortgage interest as they're near the end of their loan, and then he gives the $20,000 to charity with after-tax dollars. If you add these up, he and Jane's total itemized deductions would be $31,700. Their taxable income is just over $180,000 with a federal tax liability of $30,281. Now, let's compare this with Robert, who gifts $20,000 from his IRA. As I mentioned earlier, unlike after-tax donations, QCDs are classified as above-the-line deductions. Therefore, they don't need to be itemized to receive the benefit and are excluded from the modified adjusted gross income calculation. In this scenario, Robert and Sally's modified adjusted gross income is $192,001. Their itemized deductions are only $14,200, meaning they would simply take the standard deduction of $30,700. Their taxable income is $161,301 and have a federal tax liability of $26,101. The key takeaway is that when John donates using after-tax dollars, only $1,000 of his $20,000 contribution provides a tax benefit, since only the amount exceeding his standard deduction is technically being deducted from income. Whereas Robert excludes the full $20,000 from his taxable income while still claiming the $30,700 standard deduction. Although this results in $1,000 less in total income deductions for Robert and Sally, it lowers their modified adjusted gross income by $20,000 and reduces their federal tax liability by over $4,000. The third reason why QCDs are useful is they help retirees manage their Medicare premium surcharges, also known as the income related monthly adjustment amounts, or IRMA. As mentioned earlier, Medicare Part B and Part D premiums are based on modified adjusted gross income from 2 years prior. That means both families' income from 2023 will impact their 2025 Medicare costs. Looking at the Medicare IRMA table, if joint filers' 2023 modified adjusted gross income stayed below $212,000, they'd pay standard Medicare premiums without additional surcharges in 2025. But exceeding these thresholds, even by just $1, triggers monthly surcharges per person. Crucially, modified adjusted gross income is calculated before standard or itemized deductions are applied. This means that charitable gifts with after tax funds do ultimately reduce taxable income, but are a below the line deduction and do not impact modified adjusted gross income, therefore, do not help lower Medicare premiums. Conversely, QCDs are an above the line deduction, therefore, are not considered when calculating modified adjusted gross income, which can potentially prevent a taxpayer from being subject to Medicare surcharges. Let's take another look at our examples. In John's case, he chose to donate with after-tax dollars, not from his IRA. He and Jane's modified adjusted gross income would exceed the first Medicare surcharge threshold by just $1. Since they file a joint return, they would each pay $74 more in Part B premiums and $13.70 more in Part D premiums monthly for health coverage. That's a $2,104.80 increase for healthcare costs in 2025. Whereas Robert chose to donate directly from his IRA. In he and Sally's case, their modified adjusted gross income remained in the first threshold. Therefore, they would avoid Medicare surcharges in 2025 altogether. To sum it up, Robert and Sally can reduce their tax and healthcare expenses by more than $6,000 just by adjusting the source of Robert's charitable contribution while still providing the full $20,000 to the charity of their choice. QCDs are a great example of a simple tax planning concept that can really improve clients' tax efficiency in retirement. So if you have a charity in mind that you'd like to support and are expecting or are experiencing significant RMD obligations, we encourage you to consider a QCD. Of course, if you have any questions about your specific situation, retirement, or taxes, please don't hesitate to reach out. We'd be happy to help. Thanks.